Hey everyone, welcome, welcome. All right, we are gonna go ahead and get started. So with tax season in full swing right now, we have a great webinar for you today. So over the next kind of 30 to 45 minutes, Marissa Atkinsar from Collective will guide you through how to structure your business to optimize tax savings. And I did want to remind you too, if you stick around to the end of the webinar, we will share a promo code that will get you 2 months free if you sign up for Collective this year. So with that, I'll let Marissa take it away.
Sweet. Thank you, Amanda. Thank you, Right Side Up, for having me. Welcome, everybody. I think we've got a couple people join in the call. I may give it a minute or so to see if we got a couple more participants joining. Where are y'all calling from? I'm in San Francisco. You want to drop in the chat where you're at? Very curious to see where people are sitting. Got any other West Coast people in the call? Well, I'm representing San Francisco. I will give it maybe one more minute before I dive in. We've got a couple other people joining. Um, I'm based in San Francisco. My name's Marissa. I come from public accounting. I was a tax accountant for almost 10 years. And just over 3 years ago, I found myself in a sales role at Collective, which was a very new experience for me. Given the nature of what Collective does, the experience on the tax side was very valuable. So it made the transition somewhat easier. Public accounting's a very secure, stable, established industry. So joining a startup was a bit of a risk for me. 3 years later, we're still going strong. So glad to meet with you all. I will dive in. Today's webinar, it's good on the front end, be a really short presentation, a bit about Collective, some short education on self-employed tips, how S Corp can help save on your tax bill. And then we're just going to dive into a live Q&A session. So if you've got specific questions, we ask that you drop them in the Q&A feature within Zoom, and we'll field questions there. And this session is really for you all and for your questions. So I'm going to get started. Throughout the presentation, there are these QR codes that you can scan. If Collective is something you want to explore to support your business, you just scan that code. It'll take you directly to our team's calendar so you can book a one-on-one conversation. All right, so the tax savings and power of S Corp, we're going to dive in. Agenda, talk about Collective, some upcoming deadlines that are important to note for tax season. We're already in the thick of it. Super high level, the differences between federal and state obligations, how to avoid penalties, how to make sure that you're aware of all the forms you need to file. Quickly, we'll cover some high level saving strategies for self-employed people. And then we'll pivot over to the live Ask Me Anything. And I will rely on your participation if you've got questions. So we'll dive in. So Collective, who is Collective? What are we for? Some of you might have heard about Collective already. We did do another session a couple months ago. Collective is a platform built specifically for solopreneurs. We bundle together all the financial compliance aspects of forming and operating under a single owned S Corp. So we bundle together business formation, S Corp tax election filing, bookkeeping, payroll, business filing, all under one dashboard, one monthly fee, one login. So it's a very clean, efficient, cost-effective solution specific for self-employed individuals. This webinar is for education purposes only. Nothing contained in this or in any related webinar should be viewed as legal or tax advice. Please consider consulting a professional if you need legal or tax advice in operating your freelance business. Okay, so we don't have to read through all of these, but The TLDR is tax season is here, and Amanda and Sarah and I were just talking about how it's already March. How did it get to be here? If you have an S Corp established already, your deadline to either file or extend last year's S Corp tax return is coming up. That's the next deadline we're up against. If you're an LLC that wants to elect S Corp status for this year, that deadline is also coming up on March 17th. And then the one that everybody knows, April 15th, is your personal tax deadline. So those are the big ones coming up. If you usually file an extension, the deadline to extend is also coming up. Leave this here. You'll get a copy of this deck after the webinar so you can put these dates on your calendar. And feel free to start dropping questions in the Q&A if something that I say prompts any questions. But we're going to start here. So super high level, federal versus state obligations. We all know federal tax forms, Form 1040. You may see that on like H&R Block or TurboTax commercials. That's the federal personal tax return form. If you live in a state with income tax, a state level income tax, you're going to have a corresponding state level form that may be called something different. So the purpose of this slide is really to differentiate the fact that there are federal and state tax forms, and they may have different deadlines. Most often, the states will piggyback or follow federal deadlines. However, some states have an additional month or they don't follow the federal extension. So the purpose of this slide is really just be mindful that you may have different forms and deadlines that apply depending on where you live. Knowing when these deadlines are or how they differ from the federal deadlines could help avoid late filing penalties, underpayment penalties. And again, mark your calendars. The best we can do is put them on our radar. If you're a collective member, your collective dashboard includes all of these deadlines, and specifically your state deadlines will be pushed to your collective dashboard. So TLDR, state and federal could have some different deadlines, and being aware of them can help reduce the risk of missed filings and penalties. So saving strategies for the self-employed. The first and best advice anybody could give you, this is not a collective thing. The best thing you can do is understanding what deductions you're entitled to so that you can lower your business profit. So profit is what you bill your clients, revenue, minus expenses. So your tax write-offs, deductions, business expenses, those all refer to the same thing. Deductions reduce your profit. So profit is what's left over after you do your write-offs. Business profit is what's subject to the tax. And so the more you can reduce your profit, the more you can reduce your tax bill. So the first best advice is capturing all your write-offs. The next thing you can consider is some tax deferred strategies. So the big ones are retirement plans. Specifically, the SEP IRA or solo 401k will likely be the most applicable to this group. SEP IRA is a retirement plan that offers like higher contribution limits than a Roth or a traditional IRA. It's limited based off of your business's net income or net profit. And it's capped at something like maybe $73,000 for 2025. The SEP IRA is usually used for people who are structured as a sole proprietor or single-owned LLC when they continue to report their business activity on the personal tax return. So SEP IRA, it's simpler to set up. The contribution limits are very clear. It's a clean 20% of your net profit. That's the maximum you can contribute. And you get a deduction in the year that you make the contribution, and then you pay the tax on it in the year that you take it out. For folks who want to elect S Corp tax status, we usually see them switch over to a solo 401k. Similar to SEP, 401ks allow for higher contribution limits, which means a higher deduction in the year you contribute. The main difference here is who can contribute to a 401k. So when you switch to being an owner of an S Corp, you now wear two hats. You're both your own employee and you're your own employer, which is really advantageous with the solo 401k structure, which allows both employee and employer contributions. As an employee under a 401k plan, you can contribute a flat, I think it's 23,000 for the 2025 tax year, a $23,000 retirement contribution that reduces your taxable profit. And there's no limitation on that 23,000. So anybody who's an owner of an S Corp can do a 23,000 employee retirement contribution. Then the S Corp can make a matching contribution of up to 25% of whatever your salary is out of your business. So in theory, let's say your salary out of your S Corp is 100,000. You as the employee can contribute 23,000, and then the S Corp can make a matching contribution, 25% of your $100,000 wage for an additional 25. So between the two, we're close to what, 48,000 in retirement contributions. The employer portion is a straight up business deduction, so it reduces your business profit. The employee contribution reduces your taxable wage. So they both act as vessels to reduce your taxable income. So that's another option to consider. Next, keeping accurate records. I'm sure you've heard this before as a business owner, self-employed. Maintaining clean records can, one, help with much easier tax filing at year end if they're maintained throughout the year. There's no box of receipts that you need to sort through and scramble in December or January. Maintaining accurate records also helps you give perspective on where you can reinvest in your business. So are there opportunities to put money into marketing or an education course or a certification course so that you can be more marketable? So maintaining accurate records, one, checks two boxes, helps tax season be much easier. Two, gives you eyes on opportunities to reinvest in your business. This next tip is not necessarily a way to lower your tax, but it can help lower how much you owe at year end, which if you've been self-employed for some time, you didn't pay quarterlies, maybe you've been hit with that PTSD tax bill where you owe a ton of money at the end. Quarterly estimates are prepayments into your tax bill throughout the year. So when you're an employee of another company, you're on a payroll cadence, it's every 2 weeks, once a month, and every paycheck, there's money taken out. You've got withholdings, so paying into your tax bill with every paycheck. And there's also paying into the Social Security and Medicare tax. When you're self-employed, there's no means for that withholding. You just get straight up revenue from your clients, and then it's on you, the taxpayer, to submit these quarterly estimates 4 times a year. These are the deadlines that the IRS asks for. So that you reduce owing a ton at the end, you reduce the risk of the IRS assessing underpayment penalties. That way you're, from a cash flow perspective, you're paying into this tax bill throughout the year. And when you've exhausted all of these options, maybe it's time to reconsider your tax status. And so this is where Collective focuses on specifically the S Corp tax election. When your profit, and this is a general rule of thumb, exceeds 60,000, that's the point at which it could be time to consider electing S Corp status. Monica, I see your questions. Alexis, I see your questions. Thank you. We'll get to those in like 5 more minutes. So what's the advantage of S Corp? The S Corp is a tax status that's added on top of a legal structure. So many of you may have a single owned LLC set up already that's established with your state. That's the legal entity structure. It's what gives you a business name, a tax ID, it gives you some liability protection, and then it sets the foundation for you to add this S Corp tax status on top. So why would somebody do that? Without the S Corp election, let's say you're operating with nothing formed, you're a sole proprietor, or you're a single owned LLC. In either of those setups, the way that you're taxed is you pay 3 layers of tax under this structure. You report everything on your personal tax return on the Schedule C. You may be familiar, which means tax reporting is very simple. You file one tax return on April 15th. You can use an Excel spreadsheet to total up your income and expenses, and it's relatively simple to file. The downside is the way that you're taxed. And so your business profit under this structure is subject to both federal and state level income tax. Your income tax is determined on your filing status, so single, married, filing joint, head of household, and then your total household income. So you would consider your income, your partner's income, maybe you've got a rental property and some stocks in Robinhood. All of that combined is your total household income, and it contributes to what tax rate you fall into within your tax status. And so that's income tax. So your business profit would be subject to both federal and state income tax. Then it would also be subject to a 15% self-employment tax, which is made up of 3% Medicare and 12% Social Security. Those figures are flipped. I need to edit my slide. 12% Social Security and 3% Medicare for a combined 15% of self-employment tax. So when it's all said and done, you could be in a 22% federal tax rate, 9% state, 15% self-employment tax. Under the simple tax reporting structure, you've got multiple layers of tax assessed on the entirety of your income. So that's the downside of the simple tax reporting. When you elect S Corp status on top of your LLC, it triggers a lot of complexity. There's a need to file a separate business tax return. You need to formally pay yourself on salary, which means you need a payroll provider. You need more comprehensive bookkeeping. You need to generate financial statements, a profit and loss, and a balance sheet so that those can get reported on the separate business tax return. So the administrative lift goes up when you elect S Corp status. But here's an example of how the savings work. So in this left column, sole proprietor or single owned LLC, these are the folks that are reporting on Schedule C on that personal tax return. So real simple. This person has earned $160,000 of business profit. Under the sole proprietor LLC structure, that entire 160 would be subject to the 15% self-employment tax. So that's this 24,000. If that same entity elected S Corp status, so same business profit of 160, they paid themselves a salary of 60,000. Then only that 60,000 instead of the 160 is subject to the self-employment tax, which generates this reduction in tax of $15,000. That's just tax you wouldn't pay if you were elected as S Corp. So the trade-off here is you get an opportunity to control and reduce how much you pay in self-employment tax, but then you also agree to maintain a more complex tax profile. And the risk in not checking all these compliance boxes is the IRS could revoke this S Corp election status, and you wouldn't be able to go through this payroll process to reduce your self-employment tax. So that's the advantage, an opportunity to control and reduce self-employment tax. Now, how do you achieve all the compliance? You can totally DIY it. If you are somebody who's comfortable with tax filing and IRS jargon and looking up tax codes, you would bundle up a suite of services, maybe a service to do your LLC formation, like LegalZoom. Maybe you piece together a QuickBooks subscription with a bookkeeper on the side. You add on a Gusto subscription and set that up yourself. And then you hire a CPA or self-prepare the business tax return, I don't know, through TurboTax. So you can do it by yourself. Or if you're a fit for collective, this is everything that we bundle together. So if S Corp 1 is advantageous for your situation and collective is the right fit for you, the idea is that you would not need to separately engage all of these other services. You would just need to join collective, and we can do all of this for you. That's the end of the presentation. So I'm going to pivot over to the Ask Me Anything session. There's a couple questions in the thread. I appreciate you both, Monica and Alexis. I'm just going to dive in. Monica's asking, what happens if you elect to become an S Corp after the deadline listed on slide 1? So that deadline was March 17th. The IRS imposes a deadline to timely file the S Corp election. So they want to see intent to file the S Corp status by March 17th. You can still elect S Corp status after that, but when you do so, it triggers the IRS's late relief process. And so there's still a means to get to S Corp. It just makes the election a little bit more complex. So still doable. Also, if you do it after the deadline, it could just mean more catch-up work. Like maybe you consider catch-up payroll to be payroll compliant. Maybe it's rebuilding your books for a longer period because your S Corp will be effective at the start of the year. Totally doable. You just follow a more complex election process. Do you need to be established as an S Corp for a solo 401k? Why is a SEP IRA more popular for sole proprietors? I believe there's a way to do a solo 401k for sole proprietors. The issue with a solo 401k, or the difference, is who's contributing. And so for a solo 401k that's set up as a sole proprietor, it may not, you're not wearing two hats when you're set up as a Schedule C sole proprietor single owned LLC. And so it doesn't necessarily connect to the 401k's advantage of doing both employer and employee contributions. SEP IRA, I believe they're simple to set up. So it kind of goes hand in hand with a simple tax filing. You've got a really simple retirement option to set up. And figuring out your maximum contribution is very clean as a SEP IRA. It's just a flat 20% of your net profit. Alexis, will you be covering who should form an S Corp and why? Yes. So when is it a good time to consider S Corp status? The reason that we've got these QR codes to book time with our advisors is because determining whether or not an S Corp makes sense for you is very facts and circumstances based. It's not a one size fits all solution. I know I had that $60,000 threshold on one of the screens. The reason we have that threshold, it's super high level. It's the point at which the savings potential of an S Corp exceeds the cost of compliance or the cost of your collective membership. So most people, when they're considering S Corp elections, are looking for a tax savings opportunity. And so what's the threshold where your savings are more than the compliance, the extra work? And so that's where that $60,000 threshold exists. There are other factors that determine or play into whether or not an S Corp fits your specific situation. So for example, Alexis, if you've got your self-employed business that's making $80,000 of profit annually, but you also work a full-time salaried role elsewhere, whatever your salary is out of that other business would factor into this conversation of whether or not an S Corp will provide you savings. And it has to do with the way the IRS assesses that Social Security and Medicare tax. And so the purpose of these one-on-one introductory calls that you can book, I'll pivot over to the QR code, is to determine, is your situation suited to give you savings if you elected S Corp status? So if your sole source of income is from a self-employed business, you should consider an S Corp status if your business profit will be over 60,000. If you have both, if you have a salaried role and a self-employed business, one self-employed business should still be over 60,000 of profit. But if your salaried role is over I think it's over 100,000. It's going to start limiting the savings potential of your self-employed business electing S Corp status. And again, that has to do with the way the IRS calculates self-employment tax and the Social Security and Medicare. I know that was a lot, but for your specific situation, our team can definitely run some hypothetical high-level numbers to see if like you've got a salaried wage, if that will play into the savings potential of S Corp. If you're somebody who's building out a self-employed business, it's not quite at 60,000 yet. Maybe your goal is to transition out of your salaried role and fully commit to self-employment. A step you could take if you haven't already is at least establishing an LLC. We usually recommend in your resident state because that's where you're a taxpayer, so you have to be registered there anyway. But setting up an LLC in your home state will set the foundation to make an S Corp election in the future. So if you're not sure where it's going, but you know you're in a growth phase, getting the LLC set up will set the foundation for the next steps in the future. Anybody else feeling like they've got questions they want to run through? You can even come off mute. Sarah, are we able to come off mute? If anyone wants to just ask their question live, you can drop it in the Q&A. All right. Well, for the folks on this call, our partnership with RSU gives you 2 months free with Collective. And so the promo code is here, RSU24. It's a $700 value, which is one of the highest discounts we've ever offered. This QR code will take you to our advisor's calendar. Feel free to book a one-on-one call, find out more information, find out if Collective or S Corp even is the right solution for you. If S Corp's not the right path now, still some really great insights from our advisory team. They're self-employed experts. They can answer questions or give some insight on how to set you up for a future S Corp election. But we will be sending out this slide deck. A copy of this recording will also be in the email. I think tomorrow we'll send it out. And if you've got questions that you didn't feel like posting here, there are no bad questions, find me on LinkedIn, book a call with our advisory team, ask them those questions. If there's nothing else, maybe we'll end a little early. Maybe I'll give it a minute or two. I know I've got a couple other folks on the call. Let's see, Monica, thank you. I appreciate you. I heard that it can be penalizing to create an LLC without then converting to an S Corp. Is that the case? This depends on the state you live in. So every state, there's an LLC formation fee. So I live in California. It's a $70 LLC formation fee. That's just the initial setup. What can be penalizing is in California, there's an annual $800 renewal fee. So Monica, this applies to you. You're in California also. Simply for existing as an LLC in California, you pay an $800 annual fee. And so depending on where you're at with the growth phase of your business, maybe establishing an LLC isn't the move. If you're testing the theory and you're not fully committed to self-employment yet, maybe you test it still operating without an LLC, and that's totally fine. Maybe at the point at which you've proven the theory, like you're committed to self-employment, you like it, you have a groove, you have leads in your pipeline, that can be the point where you establish the LLC. And maybe you're still not ready for S Corp status yet. But at that moment where you've proven the concept and you're committed to it, that could be the point where getting the LLC registered with the state would be a good idea, because that's the point at which you would seriously want to consider S Corp status in the future. Other states have like really high upfront LLC formation fees. I think Massachusetts is like $500, but then they don't have an annual fee recurring like California does. So that would be the downside. Some states also have like annual reports, which you just submit with the Secretary of State website. But usually it's the fees that could be penalizing. Great question. There are no bad questions here. If anybody else has any more. All right. Well, we'll leave it at that. There are some other great resources at the end of this deck. A copy of our collective dashboard, which if you book a call with our sales team, they will also run through this dashboard with you. We've got some great guides. I know Sarah posted a 401k plan blog that we can also include in the email as well. Ton of great educational content on Collective's LinkedIn, YouTube channel. We've got blogs and guides. You can book a call with our advisory team. It's free. They're 25 minutes to ask all the questions. Maybe you might be too shy to ask here. But thank you for giving me some of your time this morning, early afternoon, wherever you're at. We'll be sending out these resources later. And thank you. Bye.